set the stage. I'm very pleased to be inviting our keynote speaker, Mr. Ruud Brouwer, who is the CEO of TCX, certainly one of the key players in this space, who will be sharing some insights on currency risk and on innovative approaches of addressing it. So Ruud, the floor is yours. And if we can have the slides.
Good morning, everyone, and a warm welcome on this beautiful morning in Cape Town. And of course, a big thanks to the organizers, so Finance in Common, AIIB, of course. Most of all, I think this is our competing session next door. Most of all, the DBSA as host, but also as investor and shareholder of TCX. I think in the coming days it's going to be difficult for any keynote not to start with a quick look at the world it is today. And I think the positive side effect is it's going to be extremely difficult to take a look at the world as it is today and being bored at the same time. It's quite extreme. On a macro or geopolitical scale, it's not a pretty picture. Climate change is undeniable. Pandemics, small or large, are increasingly part of life. And the reliability and relative stability that was brought by economic, political, or security alliances is gone. And these changes are here to stay. International trade has become completely unpredictable, as here in South Africa you know only just too well. And oil and gas are no longer commodities, but they have become political tools, and the age of international cooperation seems to be coming to an end. This means that national production, for example, of medical products, will only gain in importance. And no longer the environmental reality requires investing in an energy transition. Energy independence can best be achieved with local sun and local wind. And none of this will happen without reliable national infrastructure. These are the areas of national development banks. So in other words, the role of development finance in general and national development banks specifically will only become more important in the decades ahead of us. And it are these big questions that bring us together today for these 3 days, as we represent that sector whose purpose it is to bring growth and development. It is our job to protect people against the consequences of global changes on which they have no influence, but to which they are exposed and that negatively impact their lives. And there is one challenge that faces almost all of us when fulfilling our mandate. The fact that the countries that we serve are less rich or poor means by definition that there is a lack of local funds. Foreign capital is required to make the necessary investments happen in climate, in infrastructure, in health. And do not misunderstand me, we strongly believe also at TCX that local capital market development is crucial. However, the reality is also such that it will be taking decades for many countries to reach a level of local capital market development that is sufficient to fund the required local investments. And some countries, purely due to the size of their economy, will not reach that stage. And that does not only go to developing countries, that also applies for smaller Western markets. And foreign investments come in foreign currency. So until then, currency risk is a fact of life. And whether it is a climate disaster, a pandemic, a war, elections in a country far away, these events all have one thing in common. They translate in sudden currency movements. And I'm sorry to say, they almost always translate into emerging and frontier markets depreciating against hard currencies, most often the dollar. As an example, I mean, we all remember the global financial crisis. Well, we call it the global financial crisis, but we also know it was actually a US-based housing finance crisis. And even in the case of an American housing finance crisis, it still translated in a global financial crisis with all investors fleeing into the dollars and all emerging market currencies taking a hit. So regardless of the source of instability or crisis, the reality is people flee into the dollars, emerging and frontier markets take a hit. And as always, the poorest are hit the hardest. Poor countries lack the reserves to protect their currencies against short-term effects. So depreciations immediately translate into debt surges, making medium, sometimes even short-term financial planning impossible. Institutions like energy utilities with little reserves and too often hard currency debt immediately need to postpone investments in energy infrastructure the moment their currency is hit, making the energy transition going even slower. And individuals must bear the increased cost when a foreign country increases interest rates for national reasons. And their debt, their electricity bill of their government debt unexpectedly rises and translates in increased cost for them. So let me bring you to the last slide. As already mentioned by Barbara, my name is Ruud Brouwer, I represent TCX. TCX was actually started by multilateral and bilateral development banks to provide a global, scalable solution exactly for the currency risk challenge. We offer indexed local currency loans, meaning that governments, utilities, enterprises still can get access to the US dollar, but stripped from the currency risk. And by actually concentrating the currency risk of today about 60 currencies in one fund in Amsterdam, where we are based, it allows us, through diversification, to offer solutions that commercial parties cannot or do not want to offer. And for the most frontier markets, where affordability is a key challenge due to high local nominal interest rates, we have started strategic cooperations with parties like the United Nations, but even more at scale, the European Commission, allowing us to lower local currency interest rates to increase the affordability of the local solution. On that short introduction of TCX and setting the larger picture, I'm very happy to hand back over to Barbara and wishing you a very nice first 60 minutes of these 3 days. Thank you.
Thank you so much, Rod, for really getting us started on this discussion here. I think what I take away from your keynote here is certainly something I think we all share and agree with, that climate change is not a distant threat. It's affecting our economies, our communities, our ecosystems today. So we need to scale money. I think the domestic capital mobilization is extremely important. We're going to talk about that as well. But I think we really need to address the key barriers that keep money from flowing into the areas where and the countries where they need to go. And I think addressing currency risk, like with TCX and other solutions that we're going to hear today, I think is key for that. Just to further frame today's discussion, I'd like to share a few findings from a survey that TCX did with FIX last year, and also a few findings from a report that my organization CPI did last year on currency risks. I think both of the reports, both of them, the analysis confirmed that currency volatility remains a major concern. In the survey, we see that more than 60% of the respondents actually consider currency risk as one of the significant threats to the profitability of their organizations. And we also saw from the report, from the survey, that public development banks have limited access to local currency and hedging products. And as a consequence, about a quarter of the respondents stated they had to cancel or postpone funding for climate action, for sustainable development because of FX risk. So this is a big thing, and I think it's particularly big because, as you said, we know that the role of public development banks is extremely important to address the needs in the countries, and I think it's going to become even bigger going forward, again, as you highlighted. So without adequate FX solutions, the ability of public development banks to really play that role in financing climate action and sustainable development is severely constrained. In the CPI report that we published, and it's on our website for those of you who are interested, and our lead author actually is in the room here with us, Zainab. In our report, we also look a little deeper at some of the key challenges that contribute to this current situation. And again, we see that standard hedging tools are just not available, very rarely available, to meet some of the long-term needs of development and climate finance. But we also see that the perception of costs, of high costs, remains one of the big barriers to actually adopting some of the solutions that are out there. And it's really limiting the application and the appetite of banks to go into this direction. And I think the final challenge that we see is that 80% of current MDB funding is actually in hard currency, while the hedging instruments that we see remain complex and very limited in their application. But again, those of you who know me know that I'm always trying to end on a positive note. So I think we have seen and we have looked at a number of solutions, and I very much look forward to discussing many of them today in our panel. We have seen that there are ways to enhance the affordability, you talked about that, Ruud, and the accessibility of hedging tools. We've seen that there is lots of approaches of expanding local currency lending, especially through MDBs. But we also have seen a number of very innovative financial solutions that are being piloted at the moment to really see how can we address this issue in the short term and in the long term. Long term, obviously, being supporting the development of local capital markets, which, as you rightly pointed out, will take some time. But I think this is obviously the longer term goal we should be focusing on. So each of my fantastic panelists today is going to bring a different perspective. Everyone is working on different aspects of solutions to the challenges that we know are out there. So we'll be really thinking about how can we also better collaborate between the different actors, from MDBs to public development banks more broadly, private sector, but obviously also policymakers, to really ensure that we can scale sustainable climate and development financing. And obviously we also should not be forgetting, and we have on the table as well, the important role of the vertical climate and environment funds, such as the GCF and the CIF, who can help in this context. But with that, let me introduce my very impressive panel today. It's a little spread out here, so it's a little different setup, but it will keep you, looking for everyone and make sure that you are following everyone's remarks very, very closely. So let me start with Amar Baig, who is the Director of the Department of Strategic Investment Partnerships and Co-Investments at the Green Climate Fund. Welcome to this discussion, Amar. Thanks for being here. I'm now jumping on this side here to Marty Janse van Rensburg, who is the interim chairperson of the DBSA board. Wonderful to have you here, Marty. Close to Marty, we have Laureline Pla, who is the project manager at the European Commission, and look forward to hearing about some of the experiences of the Commission in this context. Close to me here, we have Erastus Hovevka, who is the head of credit risk at the Development Bank of Namibia, and I know there will be some very interesting insights from the practices that you are having at the bank. Across the table from me, we have Swati Chabalala, who is currently a presidential candidate for the African Development Bank, AFDB. So wonderful to have you here with us. And then on my very left hand, well, in the middle left hand here, we have Ayan Adam, who is the Senior Director and CEO of the Africa Finance Corporation Capital Partners, with lots of experience in this space, including from the GCF before that. And then last but certainly not least, again, across the table from me, we have Evans Osano, who is the Chief Financial Markets Officer at FSD Africa, very important player and partner in this space. So great to have you here as well. So let me start with the first round, just for your information, so you can get ready also in the audience here. We will have 2 rounds of like looking first a little bit at the challenges in the space and the experiences of the different organizations, and then at some of the solutions that are out there. But we will have space for some questions and answers from you. So if there is additional reflections and experiences, so please be ready once we get to that segment as well. But Marty, actually, let me get started with you first and just like look a little bit deeper into the way DBSA is managing currency risk and how are you actually working to protect your clients. So Marty, the floor is yours.
Thank you very much, Barbara. The DBSA provides lending across Africa, and currency risk issues between South Africa and elsewhere on the continent is very different. For our South African clients, currency risk is usually minimal. Most of our lending is in local currency, South African rand. We've got deep capital markets to be able to raise the funding here. And most of our clients also operate in South African rand. When we source foreign currency funding for local lending, we manage the associated currency risk internally within our balance sheet, ensuring that we can lend in South African rand. South Africa's well-developed currency market enables us to hedge and manage the risk efficiently, preventing currency exposure from being passed on to our clients. And to remark, we also get long tenors when we actually enter into currency hedges. Outside South Africa, managing currency risk is more complex, except for instances where there's a natural hedge, as both the borrowing and the on-lending is in the same currency. Most of our lending in this market is US dollar or euro, and many of our clients face challenges due to the local currency component, to convert it to local currency due to underdeveloped local currency markets with limited liquidity, the absence of robust currency derivatives market, too few market participants, particularly commercial banks, to facilitate the currency transactions, and regulatory hurdles that complicate cross-border financial operations. The DBSA is working actively towards providing local currency lending at competitive cost. Through our investment and partnership with TCX, we have successfully executed some local currency transactions, including in Tanzania and Zambia, by converting US dollar funding into local currency. However, that case still remains limited, and we are looking forward to expand such initiatives. Currency risk remains a persistent challenge in Africa. Many clients weigh the cost of borrowing in their local currency against hard currency, and then often opt for the latter and then are exposed to currency risk. And I had an interesting discussion last night. Sometimes the clients look at the cost now, but not about the potential risk on the longer term. And I think we have a selling job to do. Over time, we anticipate that this will change as more market participants will enter these markets and drive transaction costs down. Long-term hedging instruments become available and standardized. Liquidity in local currencies improves and enabling hedging of large-scale transactions in line with the size of infrastructure transactions that we are seeing, because it's quite chunky type of hedging that we're looking at. Addressing these challenges requires collaboration among all stakeholders, lenders, commercial banks, regulators, and clients. Key improvements need to include regulatory enhancements, standardized hedging instruments, increased liquidity in the underlying currency markets, better risk management education for clients, and streamlined cross-border payment processes. Maybe just on some experience that we've had, which was lessons learned, if I can put it that way around. In East Africa, in Uganda, we had in 2021 a loan approved and converted it to Ugandan shillings. The whole structure became too expensive for the borrower, and after considering the hedging costs and the transaction ended up reverting back to a straight dollar line. So it goes into line with how do we create affordable and flexibility in these hedging instruments. In Tanzania, about 10 years ago, we had also a transaction where the client did take on local currency funding, which was hedged, but also due to the cost components, they early repaid. So there is the whole theme that's coming through, and what's proven in the research is that we need to look at the cost of the hedging instruments and the affordability of that, as well as the flexibility around that. And I think I'm done with my contribution.
Thank you so much, Marta. I think very important points already, and I already see, I think, this two-way approach, like for countries that have well-developed currency capital markets and more the frontier markets, where partnerships with DCX, I think, have been helping to address the issues. And I think the other point you made also, this collaboration is really thinking about how can you work across the ecosystem between lenders, commercial banks, regulators, clients, and your bank. So really good points, and thank you so much also for bringing some of the examples, which again highlight the importance of the costs of hedging and the affordability, which I know we will be going into more in this discussion. But Erastus, let me come to you, and again, you're head of credit risk, so I'd love to understand a little bit better how currency risk is actually entering into your decisions when you're assessing borrowers at the bank. So over to you.
Thank you very much. Maybe let me first put that in context and describe who the Development Bank of Namibia is. The bank will come of age in April. It will become 21 years in existence. It is a fully government-owned bank. It has an independent board, and it is mainly confined to the local market. We do not do much of cross-border transactions. Allow me to present my views, and I will go back and forth. I'll go the past of DBN and the current. I'll go public sector development banks vis-a-vis commercial bank, because I spent a little bit of time in a commercial banking world as well. So I will juxtapose those ones as I go along. Because we are a local market, maybe let me just put it this way. Geography matters. Who you partner with matters. Because of the geographical proximity to South Africa, we have access to products that they could have, especially in the derivative market, in the swap market. We could actually access that because 4 of their commercial banks are operating in our geography as well. We have very strong partnerships with the DBSA, the IDC that's here. Continentally, we have very strong relationships and borrowings from the African Development Bank, and good luck to your candidacy. Further afield, KfW is a strong partner of us, especially with energy products. And as I will tackle my second part of it, of the presentation, I will allude to the partnership with KfW and AFD in terms of what we have done there in terms of shift and get strategy from where we were to where we are now. As a lender, you always look at default risk. That's your departure point. And obviously, if the borrower is borrowing in hard currency, but the revenue to be earned is in local currency, and if there is any sort of depreciation of the currency, in the fullness of time, the borrower will choke. And hence, we assess that at onset in terms of, how's this transaction going to travel in terms of that process for the borrower? For us as a lender, obviously, it's the old sort of adage in bank, like your asset and liability mismatches, you got to look after them. So if we have borrowed dollars and then in hard currency in dollars, and then we on lend with an entity, a public sector entrepreneur who will repay us in rands or Namibian dollars, that's just not going to work. There is a mismatch there. So our treasury shop will embark upon another strategy to do that. So in short, what I'm saying is that we rely heavily on natural currency hedging. That is, if we raise dollars, and we have raised euros before, and then we have to finance the asset that generate dollars. That's just the way the shop operate. But for the most part, it's a common local currency, domestic on lending, and that's just about it. Of late, we are beginning to see European private sector, especially private equity players, going on this solar journey, this energy journey. So buying out some of the assets that we financed, because at least we can be proud of the fact that we unlocked the solar market in the economy. Well, the commercial banks were not touching it because of long tenure and the inherent risks that are involved in such a structure. We were able to de-risk that process, and now it's opening up opportunities for international investors to refinance those, because it's just the tenure, although we can go long, you can only go as long, and the shareholders have to refinance. So we're seeing a lot of Europeans, in particular French and British investors coming through. And it's becoming now to be a challenge for us to build up a pool of assets in terms of hard dollars. But through our relationships, again, partnerships with our local bank, our own bank, Rand Merchant Bank, part of the FNB franchise, we do have a holding there that we can tap in to cater for those investors. I think at this point I will pause, and I will talk more about what we have done, especially from the resource mobilization point of view in terms of our borrowings. Thank you.
Thank you so much. I think very helpful picture of how you operate, what are the things that matter, geography matters, the partners matter. I think particularly your last point also on how you are building up good assets that then provide the opportunities for international investors to come in and refinance. So I'm looking forward to hearing more about the concrete examples in the second round. But let me turn to you, Ayan. Again, lots of experience. You have been trying to address currency risk when you were at the Green Climate Fund, and since then actually really worked to do that. So I'd love to hear more about your experiences, what the challenges are, particularly in Nigeria and the context there. So over to you.
Thank you so much, Barbara. I think a number of issues were outlined by the previous speakers, so I'll just focus on our current experience in the context of Nigeria and in the context of the asset class, that is the infrastructure asset class. So I think the point on geography matters. I think it's very important in the context of an institution like AFC. We are working across the continent. And if I can just divide up the geography matters into two, you have many Anglophone countries, Nigeria, Kenya, others, where we have seen huge devaluation of the local currency. In the context of Nigeria, 4 years ago when I arrived, the naira to the dollar was around 400 to $1. Today, it is around 1,500 to the dollar, just in a matter of 4 years. You can compare this to US euro fluctuations. It's never more than 10%. So you can understand the magnitude that has and the impact it has on an economy. The second area, which I'm going to deal with a different structure, not just so much the fact that we know we do need to develop long-term, local, long-term pools of capital. But there is another structural issue, is that we as, in a country like Nigeria, let's focus on Nigeria, it's a high importer of every good, from small soap, toothpaste, syringes in the context of COVID, and every little thing. And you're exporting one commodity as a raw material. That creates a structural deficit. Your need for dollar is much bigger, or euro, than your need for local currency. So what you have is that you have an economy where no matter what you do, you need a lot of dollars. So one of the products, actually my colleague to my left, who's from our treasury, has introduced is we then work with central bank who are in constant need of dollars because of the import and export mismatch. So we then try to get, and we have a cheaper swap with them. And that enables us to get longer term financing that we can then on-lend in a more commercial way. So there are some structural deficits that have nothing to do with the fact that Africa doesn't have long-term pools of capital, but it's the structure of our economy. The structure of our economies have not changed very much from post-colonial era, where we were 99% exporter of one or two primary goods. Maybe today we're 80%. So the more we localize manufacturing, the more we start depending on smaller things being produced in African economies, which is another major important area that we try to do within the AFC framework, is that we try to work on a number of import substitution type of local industry, where we try to create a robustness in reducing dependence on import. Extremely important. It's not a difficult one. It's a low-hanging fruit. This will reduce the high demand for the dollar, which kind of creates this uncertainty in large economies of almost 200 million people, where every little thing is imported from. So I think there is also policies that are very important, and I would leave other speakers to talk about that. That kind of enhances how do you stabilize your currency so that you can have TCF type of products applied that will work for the naira. Infrastructure as an asset class has many industries like power, transport or toll roads, you can never dollarize those for the long run. So you do need to develop local currency solutions because they become unaffordable. What's the point? People will default if you keep pegging many of these concessions to a foreign currency instrument. So I think even in the context of climate, and we try to work with Harold at TCX in my GCF days to try and find solutions for renewable energy, for climate-oriented projects, sustainable agri, where we need to look at who bears the cost, right? And can we look at some of these concessional structures from the GCF and others to avert? Because right now, all the risk is passed to the borrower. So is there a way to distribute the burden, if I can say that way, where some of the public development institutions take on some? We create structures that enable for the borrower not to assume the full load cost of local currency. I think I want to touch upon on education. There's a lot of education that's needed. At times you see, especially when interest rates were lower, and that was just in these 4 years, you know, the dollar rates went from less than 1 or 2% to around 5, 6, 7%. So there are times people look at that and they look at the local rates at 15, 16, and they say, well, it's better for me to borrow in dollars. But the reality is next year, the devaluation could be higher, and if your revenues, so there's a lot of education in every form that needs to take place. We talked about distribution, who bears the risk, how do we, I think solutions have to look at really changing the structure of reducing imports, and also how do we distribute the cost of the hedges. I'm going to end there and maybe come back. Thank you.
Thank you so much, Ayana. I think really important to keep in mind the structural deficits, as you called it, or this mismatch, and really think more broadly about what needs to be done, not only looking towards local currency markets, but I think more broadly, how can you bolster domestic markets, including the manufacturing and everything, and better kind of find better structures that can distribute the burden. And again, I hope we will be going into a couple of these examples, but let me come, Shwazi, to you. You bring obviously very deep experience, both in the corporate sector, but with AFDB as well. I'd love to hear a little bit about your experiences with addressing currency risk, and how can you actually really ensure that a larger share of lending will be happening in local currency. So over to you.
I should know how to do this. I've sat at enough round tables, you would think I would. But thank you very much, and thank you for the opportunity to be here. It's been interesting listening to the responses. So I think that it is worth emphasizing some of the points that have already been raised around macroeconomics, because in a way, you can argue that a discussion focused on how we deal with the foreign currency risk is maybe a palliative to a really fundamental problem, in a lot of the economies, certainly in the region, which is this mismatch, the structural deficit, that we talk about. And I think as development institutions, this is what we need to focus on. How do you get countries to be able to produce, first of all, their own requirements as much as possible, but also, a variety of exports as well to be able to generate, the external revenue that will help them to achieve a better match between their liabilities and their assets. So that aspect of it is very, very important. And obviously, I look at the opportunity, afforded by the Africa Continental Free Trade Area as, one aspect of, trying to get African economies to evolve and, get that structural change that's required to actually fundamentally address these issues. And of course, I think the development of domestic capital markets is an important consideration as well. But it is also a function of the structural macroeconomic, reforms and changes that are required. So, I think this needs to be a two-pronged effort. There's the long-term effort to try and make these structural changes in the domestic economies and to encourage intra-Africa trade. But, then there's the sort of short-term interventions, which I think is what all of us are trying to do in our respective, areas to try and help countries that have immediate needs. There's absolutely no doubt about it, deal with the risk of, foreign currency. And I mean, I think it's also a little bit, more complex, than perhaps, is talked about often. So, what is the role of commercial banks? I've been a borrower before and had many commercial banks come to me and say, oh, you should issue, because there's demand, we will underwrite, that sort of thing. Many ministers of finance will have these visits. They will go and issue in whatever currency is being proposed. The commercial bank will underwrite, but sell as soon as possible so that, they don't have that exposure. And, and really then left with the problem. And I do think that there is a bigger role for commercial banks to play in this and really assist in helping, to have an open and honest conversation about, what our respective roles are in this ecosystem. This is important, to me because I think somebody already mentioned about, the maybe information gap, education gap, that we all have a responsibility to make sure that, the borrower understands what it is that they are doing and the consequences of what, they are doing. And of course, I think that, the MDBs have a very important role to play in this. We do have, and I'm including regional development institutions, of course. Many of us have a privileged position in terms of our relationship with many of these countries. And we need to have these conversations. And we need to make sure that as much as possible, countries get the right advice for, the financing that they are doing. But it's a very difficult thing because fundamentally the issue is that there is limited access to this type of financing, and ministers of finance have to make decisions about, how, they finance the, requirements of their economies. And sadly, many of them don't have a whole lot of options. So they take what they can. So if I can emphasize really the responsibility that all of us as an ecosystem have towards making sure that, the countries, that first of all, we are working towards a sustainable development, which is, helping local currency markets, develop, is very, very important. It makes a difference. And, when I worked at the African Development Bank, this was important. So, as you know, the bank does lend in local currency in some jurisdictions, and it's really a function of how deep that market is and the sophistication of that market, but also working with countries to help them to develop, the domestic capital markets. But also working with, organizations like TCX, as sort of, if you like, intermediaries. Sometimes MDBs cannot, do the sort of thing that, TCX can do. To try and, help countries deal with currency risk. But also, I think, the whole issue of understanding risk in Africa, the risk drivers and all of those kinds of issues, these are all the policy reform type of discussions that are being led at different levels, in the continent. So, I would say this is a complex problem. It's actually a lot more complex than the title would suggest, and we need to come at it from, different angles, bringing our own expertise and particular, leverage to the discussion for a sustainable development, because I think that's what I'm interested in. Thank you very much.
Thank you so much, Swati. I think having this honest conversation about the role of each and every one of the actors in the market, and I think really understanding the responsibility of everyone and what everyone brings to the table, I think is extremely important. So very good insights here. But let me come to the Green Climate Fund directly. Amar, you obviously at the GCF, you are putting much more emphasis on delivering local currency financing. So would love to hear how that's going and what some of your priorities are.
Yeah, no, thank you very much. Pleasure to join everyone at this panel. Maybe I'll just start briefly to give an overview of the GCF, because not everyone is familiar with the extent and flexibility that we have. So today we're the largest multilateral climate fund. We're the only fund that can transact with any kind of counterparty, and our capital, which in the latest replenishment cycle is just over $10 billion, can be structured in any way whatsoever. So we can structure it as grants, debt with different levels of concessionality, and equity with different levels of concessionality. And we have done guarantees as well in the past, but in the absence of a credit rating, it obviously makes it more challenging to structure those efficiently, but we're working on developing more of a product line in that space. So that enables us to engage in challenging issues like managing currency risk in a way which is different to other participants in the market, because the way we've done it historically to date is to provide an enabler by providing highly concessional financing to different participants who then on-lend into local currency. And whilst our financing hitherto has been in US dollars, the degree of concessionality is effectively building in some absorption capacity for adverse movements in the FX rates. I think the challenge for us is, okay, so that's one way to do it. Is that the most efficient way, or are there other local currency instruments that we at GCF should be and can be developing with the public development banks and other local actors who are best placed on the ground to see how we can address these challenges much more? And that financing additionality for us is incredibly important. So I do envisage situations where we could provide deeply concessional funding as an absorption cushion. The challenge then becomes, okay, well, how do we avoid that becoming a sort of permanent subsidy, which doesn't really work, except perhaps in the most extreme tail circumstances where it may be warranted? And how do we develop the market to not become reliant on the subsidy, but to actually develop a deeper local currency capability? And that's where organizations like TCX and others are trying very hard to do that. And our ability is to actually be able to help in those respects as well. And finally, we're looking at other elements where and a number of speakers have mentioned this as well, where we can use natural hedges and provide direct financing in local currencies against projects in that currency. So we're removing the FX risk. That's all work in progress. As some people know, the GCF came under new leadership just over a year ago, and we're doing a lot of changes. And so, happy to go into some detailed examples as this discussion continues. But the other thought I'd like to leave participants here with is that we're very much open to developing and co-creating new ways of addressing this kind of problem. And we have the bandwidth and we have the resources to do so. So I strongly encourage anyone who has really smart ideas to come and talk to us, and very happy to engage on that.
Thank you so much, Amir. I think really helpful to understand the various approaches that you're using at the moment. I think this focus on financing additionality is extremely important, and really how can you ensure that you are not reliant on a subsidy, and also, help develop these markets. Certainly, I think the call for action here and thinking about innovative ways of co-creating, I think is something to every one of you. If you have ideas, I think there is someone to talk to. But I think, let me come, Laureline, to you, because I think also the European Commission, I think, has been really active in helping develop those solutions. We've heard a lot about cost, about affordability, and you are working very closely also with TCX on really thinking about how you can reduce the currency risk exposure of borrowers, particularly in least low-income countries. So I'd love to hear a little bit your experiences and what you believe in the program that you are developing and have launched with TCX.
Thanks a lot. So the Commission is really a long-standing supporter of TCX. We are convinced that increasing access to local currency financing and raising awareness on currency risk are really critical in order to build resilience and sustainability and to crowd in private capital toward emerging markets and developing economies. And that's the reason why we are working with TCX in order to design innovative blended finance mechanisms to increase local currency financing. In 2020, we launched the EU Market Creation Facility together with our partner KfW and TCX, really to achieve this critical goal of increasing access to local currency financing. This was done through the support of the European Fund for Sustainable Development, which provides guarantees in order to crowd in private sector investment to emerging markets and developing economies. Under this EU Market Creation Facility, the Commission provided two guarantees. One that was called the capacity component, and that provided junior loss protection to TCX, and really enabled TCX to further grow and attract capital to its capital base. This was one of the fastest deploying guarantee programs that we have created so far, and a very impactful one. We also designed a guarantee facility that we called the pricing component, and that through an innovative guarantee structure enabled TCX to provide swaps at discounted prices in the frontier markets where affordability of currency hedges is really an issue. And so this was a 20 million pilot program where the 20 million guarantee provided by EFSD enabled TCX to provide 60 million of discounted swaps. And so again, a very impactful and successful facility. Because we were so convinced of the results and the impact that can be achieved through TCX, the Commission decided to further increase its support to TCX under the successor of the EFSD that we call the EFSD Plus, and under which we have designed a new package of guarantee programs with TCX. Last month, we announced the signature of a guarantee program that we call the Capacity Component Plus, and which brings an additional 245 million euro of junior loss protection to TCX capital base. And so we are really looking forward to the implementation of this program that will enable TCX to increase the volume and number of transactions that it can hedge in emerging markets and developing economies. We are also designing a pricing component plus, so building on this innovative structure that we had, and for which we are in the final stages of the negotiations, and really increasing a lot our support, so from the 20 million guarantee to now 150 million. And we are hoping to be able to announce it soon to you. So as I was saying, in the final negotiation stages. That's it.
Thank you so much. I mean, this is fantastic to hear there's real action. And you, I mean, going from 20 million to what you're close to be launching. So that's a preview to everyone. So you made the right choice to come in this room here. You are getting some news that others don't know. So I think that is really great, really thinking about how can you first innovate, doing pilots, but then really think about scale, which is exactly what needs to happen to close the financing gaps out there. So thank you so much, Lorraine. But last but certainly not least, in this initial round and the second round, I'm going to ask everyone to be very brief so we can have a few questions, comments from the room. But Evans, let me come to you. We've heard a lot about, ultimately we do need to develop domestic capital markets. So what can be done? FSD Africa obviously has been working a lot in this space. Would love to hear your thoughts on that.
Yeah, no, thank you very much. And a lot of the things I wanted to say have been touched on a little bit. And I liked your intervention about looking at the economic transformation of Africa. It's very, very important because we have to start looking about competitiveness, increasing productivity. If we don't do that, we're going to have this structural problem of mismatch of exports and imports and currency depreciating, over time. And then, of course, if you look at the continent in terms of the transformation that we need, the capital that is required cannot be addressed adequately by the savings that are being generated at the moment. So we need external financing, but we also need the domestic financing to play a role in this. And sometimes that's where I see the mismatch, where we focus a lot on the external, but we don't focus nearly enough on the domestic. And so that's a bit I wanted to address. And in addressing that, I'd say there are probably three things I could say. One, good news, some challenges and some opportunities. On the good news side is as we address the savings gap, we know that the pools of capital that are accumulating in the continent, especially among institutional investors, are increasing quite significantly. Last year, we did a study with the Task Force for Blended Finance, and indeed, we understood there's about $2.4 trillion of assets under management. I think that number is probably closer to $3 trillion. By 2040, we'll be talking about $7 trillion of assets under management in the continent, and that's very, very, very conservative. Today, most of that money is invested in government securities and a few stocks in the public markets. And so we need to try and encourage the movement of that capital to where it is needed to support the economic transformation in the continent and, of course, including the climate challenges. Now, so how do we do that? How do we make that possible? First of all, it's to make it easy to invest in the continent. If you're going to raise capital in long term in the capital markets, sometimes it can be complicated, and so sometimes investors or issuers will be looking at what is available within the banking sector, and there's a mismatch. So we have to make it as easy as it is to get funding from the banking sector by improving regulations, by reducing the costs, by reducing complexity, and improving the timelines for getting access to the market. And of course, by improving the confidence of investors on the regulation and supervision of the markets. We also have to build market infrastructure. So market infrastructure basically enables us to reduce the cost of transactions, is the planting we talk about in the market. So at FSD Africa, we've been involved in a number of those interventions, including the new exchange in Ethiopia, the Ethiopia Securities Exchange, a new exchange in East Africa, EABX, as well as new guarantee facilities as well. And then, of course, we have also to demonstrate that this is actually possible. And we have been fortunate to have supported about $1.4 trillion of assets, no, $1.4 billion, I wish it was trillion, $1.4 billion of local currency financing for over 20 different issuers, some of them in the infrastructure space, the likes of ONCF in Morocco, that are building, all have built a high-speed rail. They have come to the market twice now, raised $200 million in the most recent issuance in local currency. And there are many smaller ones in the renewable energy space and all that. So we have demonstrated that it's actually possible to raise funding from the markets and all that. And then, of course, for the MDBs, we are working on a fund that was part of the capital adequacy framework, because we call it local currency solution for MDB portfolio transfer. Essentially, what we want to do is replicate what the ILX is doing, but we want to work with the domestic investors who can bring local currency and co-invest alongside MDBs. And so hopefully address partly that currency mismatch, and in some cases also refinance some of the assets that MDBs have created with long-term local currency, financing. So there are quite a number of examples that I can, provide on how we can engage the markets. But all I can say is that it is a long-term process, but we have to start now, because that is the holy grail. If we don't do it now, in 5 years, in 10 years, we'll not have deep markets that can be able to support the transformation of the economies in the continent, and to invest in long-term assets like infrastructure where that funding is needed. Otherwise, then what will happen is, as you try to manage the hedges naturally, then you'll restrict yourself to only sectors where there's a natural hedge in terms of creating revenues and all that. But so it is very, very critical that we need to think much more broadly on what we need to do and to put the money right now to build the capacity in the markets. And we've seen from the examples that I've just cited, a few of those examples, that we can be able to increase funding and the maturity transformation in our markets.
Thank you so much, Evans. Very important to kind of, again, how do you build that capacity? How do you bolster domestic markets? So I think the points you made, extremely important to make it easier to invest, build this market infrastructure, but I think very importantly demonstrate, and again, this is something that I think all of the panelists here are doing. We are at about 18 minutes to the end of the session, so I think I'm going to change the run of show a little bit and just seeing if there's any questions or remarks from the audience before I go back to a final round to look a little bit at the solutions experiences at my panelists. But let me just see if there's anyone who would like to share experience or pose a specific question. Otherwise, I'm sure that the panelists will be available also after the session. So if I don't see anything, I think I'm going to go in my second round. And again, want to really hear from all of you about some of the solutions, but also what you need from your lenders or donors to become more resilient and reduce currency risk exposure. And Erastus, let me actually start with you before I go to Ayan and Swazi. So over to you.
Here's the problem. It is safe to assume that public institutions, public banks are funded by government. The equity should come from government, then it makes it easier. But I think, as my colleagues alluded to, let's think about this thing a bit broadly. What's the issue? The government, because of imports and exports, my colleague from Nigeria, because of budget challenges, the government doesn't have the resources to fund public infrastructure. And hence, this is a source of this risk that we're discussing, because then you have to go out and borrow. Borrow, what do they typically rely on as governments? Contingent liability issue guarantees. And then once you have the guarantees, you go to the market, whoever is a friendly investor will invest. Here's what we have done. About 20 years ago, you go to KfW, any one of those, it's either in euro, dollars, or take a hike. 20 years later, we insist. In fact, that's a point of departure. Their point of departure is that there got to be a government guarantee. We insist that the borrowings will have to be in local currency, period. We just did, $1 billion with the African Development Bank now. I think it was concluded, approved in December. Through our negotiations, rand-denominated facilities or not. And the reason we do that is because they can leverage the AAA-rated balance sheet, whether it's KfW way of doing it, and get better resources in terms of hedging at source. And because there is a market that is transparent, that is the JIBA market, the intermarket in South Africa, they can price off that benchmark. So that's what we have done, and what also in terms of yes, there is the quantum that you will borrow, but also we want it to be blended with a grant type of component to reduce the cost. So that's the bit that we have done on our part. Thanks.
Thank you so much for sharing that. Ayan, let me come to you.
Just briefly, thank you so much. I think this is a very important panel. I think we still need to expedite the transformation of reducing imports. It's so important. I think we do need to look at specific creative mechanisms where there's a cost sharing, the burden of huge devaluation, so that it's not all with the borrower. I think we need to look at something that supports climate action without transferring a significant amount of risk to the ultimate beneficiary. I think we are in a very difficult climate scenario. Pools of capital are limited. I think we need to use them wisely so that we can transition and also adapt to the current impact of climate in a sustainable manner, in an affordable manner. And I think education is key. Thank you.
Fantastic. Thanks so much, Ayan. And Swazi.
Thank you. Thank you very much. I mean, you know, my focus is on making sure that the transformation that needs to happen in Africa happens. Fundamentally, that's what we need to look at. But I also think that MDBs could be doing more in terms of facilitating local currency, you know, financing. So I know that efforts incrementally, and I'm very pleased to hear about what's happening in Ethiopia. And of course, they started this some years ago with a commodity, you know, exchange, exactly. So these are the sorts of things that I think MDBs should be doing, because again, we're talking about a more sustainable way of dealing with these, you know, types of risk. And of course, the extent to which we can partner and work with, you know, you know, organizations that are focused on this, you know, we should, MDBs should do it. So you know, lending. So the problem with MDBs, just quickly, is of course that you know, they fund either in foreign currency, in dollars, or you know, SDR in the case of the African Development Bank. So you know, they approach their risk management on the basis of what you know, how they fund themselves. But in the context of that, you know, there should be opportunities to look at increasing lending in local currency. So thank you.
Fantastic. Thank you so much. Marty.
I think if I listen to the debate, I'm going to change my answer a little bit here. But I do think it's important that we actually explore more innovation and the role of some of the concessional facilities and lines that can be made available to be able to ensure that we develop deeper markets for currency hedging. So I think that's the one thing that I think we need to do. I do think there's a lot of collaboration. I think there's some lessons learned around the table that we can share to see how we develop that further and actually putting it in action. I think the one thing, and Swazi mentioned the Africa Free Trade Agreement. And the question I had is, do we trade in dollars between Tanzania and Zambia? And is there maybe an opportunity to create trade in local currency or an exchange between the two neighboring countries' currencies? So I think that is something that we haven't touched on, but maybe there's an opportunity to deal with that. And then lastly, where we are at DBSAs, we will definitely look to seek the opportunity of the extension of local currency loans into the outside South Africa transactions. I think we need to relook at that. I think guarantee products, in addition to some of the hedging side, may help. And then I want to say is TCX, I didn't say that they bring additionality. I think they are taking the risks where maybe the commercial banks won't step in. And I think we need also to see how commercial banks maybe play their role in working in the structure. Thank you very much.
Fantastic. Thank you so much, Marty. Very helpful. Imad, let me come to you.
Yeah, I'll just focus on one point in particular, which is the cost of hedging. I think, and Ruud knows this, that one of the things that is consistently thrown at TCX is that they're too expensive. And that may or may not be the case, but the challenge is, what's the market clearing price at the time? And therefore, how can we use concessionality to, in the short-ish term, to buy down those costs, to make them more attractive to the users of those instruments? But I think when we do things like that, we need to think about, well, what is the package of measures that we're putting in place in order to help development of local currency markets as well? So it's not just an isolated move to buy down particular hedging costs for a given currency in a difficult country, but we're looking at the overall package and then agreeing what is the pathway to the point when those subsidies won't be needed. And if we feel we can't get there, then we need to go back to the drawing board and think, well, what are the alternative solutions? And you know, maybe when we think of it as a package, there's also a linkage which could be made to all of the country platform discussions that are going on as well. And maybe it needs to be incorporated into that, which is potentially a very powerful tool.
Very helpful and very good point. Certainly something I think that over the last days particularly we've been focusing on quite a bit with lots of leadership from South Africa. But Laureline, let me come to you.
Thanks. So the Commission has the Global Gateway Strategy that aims to bring 300 billion of investments towards emerging markets and developing economies by the end of 2027. To achieve that goal, we believe that local currency financing is essential. As many of the panelists today said, it's essential that we share the burdens of managing the currency risk with the borrowers, and also that we improve the affordability of the instruments that are there to hedge that currency risk. And so this is why we are such a strong supporter of TCX under this current multi-annual financial framework for the guarantee programs that I explained earlier. And for our next financial framework that will start in 2028, we have also set up a task force that focuses on local currency financing and how to manage the currency risk. And we are looking at further ways to address those critical issues.
Fantastic. Thanks so much for sharing that. Evans, let me come to you.
Yeah, thank you very much. Maybe 3 points, maybe two and a half points. The first one is around the local currency issuances. I hope to see more MDBs, public development banks, actually coming to the market and issuing more local currency financing and working much more deliberately with domestic institutional investors in other structures and the private sector as well, so that we can increase the mobilization number, which is today not so high. And then the last point I wanted to mention is around regionalization, and we've touched about that on the trade side, but I think on the investment side, we can do much more, because today it's very difficult for an investor, say in Nigeria, a pension fund, to invest and fund a project in Ghana, which is a neighboring country more or less. And so we need to basically try and remove those barriers so that capital can flow much more easily within the continent. Yeah, so that's probably what I could end up with at this point in time.
Thank you so much, Evans. Ruud, I'd love to come back to you, actually. Again, lots of mentioning of TCX. I think TCX obviously has been also advocating for more local currency funding for quite a time and for better protection of the borrowers. So I'd love just to hear from you, what has changed over the last years? What's your priorities?
Thank you very much. and I also like to bring together what we've been hearing this morning. So for the coming years, T6 will be calling upon all lenders, multilaterals, official bilaterals, to apply what we call the ACT principle. And the A is to alert borrowers that whenever they borrow in hard currency, there is a risk involved in it. It's a standard in the medical industry that if you give someone medication, that you say, hey, there are side effects. However, in the development finance industry, the dollar prescription is given without a warning for the side effects. As Ayan already indicated, a Tanzanian borrower will say, hey, I pay 5% on the dollar, 15 on the shilling, so let's go for the dollar, it's cheaper. It's not. Whenever this is applied, the borrower will actually become a speculator and not a borrower anymore. So we want borrowers to be alerted by their lenders. C is compare. I think it's the responsibility of the borrower to actually compare alternative solutions. Local market solutions with all the options that are there, including the benefits of local market development, maybe partially dollars, including all the risks that come with dollar funding, and then partially hedging, allowing us, for example, to sell that in the international capital markets, and so creating access to the international capital markets also for local borrowers, especially sovereigns. So we want lenders to alert, to compare solutions, and thirdly, to transact. That if their borrower, whether it's private or sovereign, has a specific preference for a combination of these three options, that they make it happen. That the borrowers do not think from their own balance sheet, that is dollar or euro, and offload the risk. No, that they think from the balance sheet of their borrower, because ultimately, specifically in the world of development finance, the purpose of that industry is to protect borrowers. And offloading currency risk is contrary actually to the mission of the world of development finance. So lastly, I think these three letters, alert, compare, transact, is exactly what the people here at the table have been discussing this morning. So I hope it will be echoed a lot in the coming 2.5 days.
Fantastic. Thank you so much, Rod. Thank you so much to everyone here. I think a very rich discussion. I've been, as you've seen, been taking lots of notes, and I'd love to just very briefly kind of sum up what I've heard here, and I think some of the action items to go forward. We have one question. I'm not sure whether we can go a few minutes over as we started 10 minutes late. We can, so please, before I sum up, let me ask you to, Jaminette, introduce yourself, please.
Good morning. My name is Vincent. I am South African. And there's something I just want to ask, which is that shouldn't we be asking ourselves here the following question? And the question is there a need for an alternative system? And the basis of which I'm raising this is as follows. We know that developing countries, particularly in Africa, I'm just making an example with the continent where I live, face this challenge. And we keep on going back to the conventional. And I assume that, I don't assume, let me state it as a fact, that the people sitting here is what I will term intelligentsia. So maybe there is a need for that system. For example, I see there are people from Holland here, and let me just make an example. Holland is a wealthy country. And if I make an example, though I don't want to associate Africa with poverty only, I'm quite cautious about the point I'm going to make. Holland is a wealthy country. Why can't Holland government, for example, say to Mozambican government, we will give you money in the form of loans, not aid, in Mozambique and Metikai. Pay us as Holland in Metikai on one-for-one equivalent basis. If the exchange rate has moved, let, for example, Holland government accept that. That is at my cost. I'm developed, you are underdeveloped, and I will call that development premium. So let me stop it here. I just thought I would put this different idea on the table and say, there are people who make billions a day in FX. They are interested groups.
Great. Thank you so much. I
Thank
think
you.
it's very helpful to get like the broader perspective. I think very good to have that at the beginning of these 3 days, where I'm sure we will be going into more details and thinking about alternative approaches. So thank you for your contribution here. But just again, to very briefly sum up the conversation we had on this table here, I think what I've heard is that there are many approaches that are being tested or are being applied, from natural hedges to facilities, to improve affordability, to other ways of supporting actually to develop local markets. What matters, I've heard that very loudly, I think, is macroeconomics, the structural deficits, geography, partners and their capacity, but also cost and complexity. So what can we do, and what do we need to do to make progress in this space? I think first have this honest conversation about the role of different actors, including commercial banks. Second, think about how you scale what already works and make that really in order to close the gap, but at the same time innovate and demonstrate how we can use money more effectively, how you can improve affordability and accessibility, including possibly through country platforms. Third, ultimately help really development local currency markets, or bolster domestic markets more broadly. Very strong point around educate and build capacity, as Ayan has said, but also, like Marty said, I think learn the lessons. This is not to reinvent the wheel. There's lots of lessons out there, so let's share those lessons and make sure we build on those. I want to end on saying I do see a huge opportunity here. There is a need for an economic transformation just on this continent. Again, we heard from events, there is 2.4 or almost 3 trillion of assets under management. This is an opportunity. This is an opportunity to build closer bonds between countries, including with Marty's idea there. And I do want to end on what was at our title. I think the role of public development banks, from MDBs to national development banks to subnational development banks, is critical. We've heard that they do lend in local currency, they do partner with those on the ground, they do help raise awareness and build capacity, and they do help develop domestic markets. So I think huge role to really partner better with the whole ecosystem of public development banks. So with Ruth's final comment, let's act and let's work together. Thank you so much.